On April 7th, Donald Trump announced a ceasefire with Iran. And the very next morning, the markets exploded higher. The S&P jumped 2.5%. The Nasdaq surged nearly 3%. The Dow climbed more than 1,300 points, its best single day in almost a year. A few weeks later, stocks were sitting at all-time highs. Traditional financial media called it a relief rally. Markets celebrating peace. The war was over. By everything. Except the war was not over. The ceasefire was actively falling apart in real time. And the Strait of Hormuz, the most important oil choke point on the planet, was still essentially closed. Maritime intelligence firm Windward, which uses AI to cross-reference GPS signals with satellite radar, detected only 5 outbound carriers moving through the strait by midday on the day of the rally. That is a 96% collapse in activity compared to the pre-war baseline of roughly 130 daily transits. So if the world was not actually at peace, what exactly were the markets celebrating? And the honest answer is that the markets were not celebrating anything. They were being squeezed. And once you understand the mechanics of what actually happened, you will never look at a financial headline the same way again. To understand the squeeze, you first need to understand what Wall Street looked like going into the ceasefire. Because the setup for what happened on April 8th was built over the previous 6 weeks. On February 28th, the United States and Israel launched joint airstrikes on Iran. Supreme Leader Khamenei was killed. Iran shut down the Strait of Hormuz. And over the next 5 weeks, the S&P 500 fell nearly 9% in what became the worst losing streak for the index in almost 4 years. But the headline number was not even the most alarming part. What was happening underneath the surface was far more dangerous. Goldman Sachs runs what is called a prime brokerage desk. It services most of the major hedge funds on Wall Street, which means Goldman has a direct front-row seat to exactly what these funds are buying, what they are selling, and how leveraged they are. And according to Goldman's own internal data, hedge fund selling in North America during the first quarter was the largest since April 2020. Gross leverage across the hedge fund industry was sitting above 300%, near an all-time high. And short exposure to macro ETFs like SPY and QQQ hit the highest level since the pandemic. The professional money on Wall Street was not cautious. It was terrified. And the reason for that terror was the oil market. Commodity analyst Rory Johnston laid it out plainly in mid-March. With the Strait of Hormuz closed, the global economy would need to shed 15 million barrels per day of demand just to balance supply. In his words, the disruption was bigger than anything in history. Every analyst he spoke to, not the alarmists, not the doom posters, the measured serious professionals, all of them were terrified. His price target in that scenario was $250 to $300 per barrel of Brent crude. And recession, he said, would be too light a word. We would be looking at something depressionary. That was the backdrop. Maximum fear. Record short positioning. Hedge funds selling at the fastest pace in 13 years. The professional investment world positioned for a catastrophe. Then Trump announced the ceasefire. And here is where the real story begins. Because what happened the next morning was not a relief rally driven by investors suddenly feeling optimistic about geopolitics. What happened was a mechanical chain reaction. 3 dominoes falling one after another in a sequence that had almost nothing to do with whether the war was actually over. The first domino was the short squeeze. When you short a stock, you borrow shares and sell them, betting the price will fall so you can buy them back cheaper and profit the difference. But if the price goes up instead of down, you are in trouble. You still have to return those shares you borrowed, which means you have to buy them back at a higher price than you sold them at. The longer the price rises, the deeper the loss. And at some point your broker issues what is called a margin call. Either add more capital immediately or close the position now. When enough traders get margin calls at the same moment, they all have to buy back their shares simultaneously. That buying pushes the price higher. Higher prices trigger more margin calls. More margin calls trigger more buying. The cycle feeds itself and the squeeze accelerates. On April 8th, with macro short exposure sitting at the highest level since 2020, the squeeze began. And it was enormous. But it was only the first domino. The second domino was the systematic funds. Commodity trading advisors, known as CTAs, are algorithmic trading firms that operate entirely on rules-based models. They do not read earnings reports. They do not watch the news. They do not have opinions about geopolitics. They follow trends. When the trend is down, their models say short. When the trend is up, their models say long. Pure mechanical reaction. Goldman Sachs reported that CTAs were sitting on approximately $30 billion in net short positions going into the ceasefire announcement. But the second the S&P 500 crossed certain predefined trigger levels, those models did not flip to neutral. They flipped to aggressively long. Goldman originally estimated these funds would need to buy back around $40 billion of equities to cover their short positions. The actual number turned out to be $86 billion across just 5 trading sessions. According to Goldman's own records, that is a top 5 buying speed print of all time. Not of the year. Of all time. The third domino was the options market. Dealers who sit on the other side of options trades are required to stay what is called delta neutral. When customers pile into call options, dealers must hedge by buying the underlying stock to keep their books balanced. Spot Gamma, a leading financial data platform, had flagged what is called a negative gamma regime heading into the ceasefire. In a negative gamma regime, dealer hedging becomes procyclical rather than stabilizing. When price goes up, dealers buy more stock to hedge. That buying pushes the price up further, which forces dealers to buy even more. The feedback loop amplifies every move in both directions. Short squeeze. Systematic flip. Dealer hedging cascade. 3 separate mechanical forces all triggering simultaneously, all in the same direction, all building on each other. That is the rally. That is what actually happened on April 8th. Not peace. Not optimism. Not a fundamental revaluation of the global economy. A mechanical chain reaction that the structure of modern markets made almost inevitable. And this is not the first time this movie has played. In December 2018, stocks had been collapsing for months on fears of aggressive rate hikes. Then Jerome Powell walked onto a stage and said one word. Patient. The Dow exploded higher by more than 1,000 points in a single session, the first time that had ever happened in history. In August 2024, the Bank of Japan hiked rates for the first time in 17 years. The yen carry trade began to unwind. The Nikkei dropped 12% in a single day, then bounced 10% the very next day. Different catalysts every time. Identical mechanics underneath. And the reason this pattern keeps repeating is that the stock market itself has been structurally transformed. 20 years ago, the market was dominated by humans. Portfolio managers reading earnings reports. Analysts building financial models. Discretionary professionals making decisions based on what they genuinely believed companies were worth. That market is essentially gone. Today, 63% of all U.S. stock fund assets are held by passive index funds. That is more than $13 trillion of capital that does not read earnings reports, does not care whether a company had a good quarter, and does not have a view on geopolitics or interest rates. It follows the index on autopilot. And because most passive funds are market cap weighted, the bigger a company gets the more of it they automatically buy, which is how the Magnificent Seven now makes up more than 33% of the entire S&P 500. A massive portion of the market is not being priced by human judgment anymore. It is receiving automatic allocation by default. What remains of the active investing world has also been transformed. The hedge fund industry has consolidated into a handful of giant multi-strategy firms. Millennium. Citadel. Point72. Their assets under management have grown exponentially over the past decade. And these funds typically run at 4 to 8 times leverage with strict drawdown rules. When they hit a drawdown limit, there is no conference room debate. No discussion of whether the Fed will cut or whether the war is really over. The algorithm sells. Immediately. Automatically. Without opinion. And layered underneath everything is the options market. Same-day expiration options now make up around 63% of all S&P 500 trading volume. On peak days, more than $2 trillion of notional value changes hands in a single session. Every single one of those options contracts forces a dealer on the other side to hedge in real time, buying or selling the underlying stock to keep their books balanced. The result is a market where the dominant players are not analyzing value. They are reacting to price. And when price moves, their reactions stack on top of each other and amplify the move further in whatever direction it was already heading. This is the stock market of 2026. Not a machine for discovering the true value of companies. A giant feedback loop of algorithms, passive capital, and options dealers all reacting to each other in real time. And the headlines, the ceasefire announcements, the Fed speeches, the earnings beats, they are not the cause of the moves. They are the trigger. The spark that sets off a mechanical chain reaction that was already loaded and waiting. The next time you see markets ripping to all-time highs while the world looks like it is falling apart, you will know what you are actually watching. You are not watching investors decide the future is bright. You are watching dominoes fall.